Our next guest suggests the market is underestimating odds of a Fed pivot. Nancy Davis is the Chief Investment Officer at Quadratic Capital Management. She runs the firm's interest rate volatility and inflation hedge ETF. Nancy, welcome to the show. Welcome back to the studio. First time since 2019. We had a chance to chat in the green room, so it's not necessarily a Fed pivot, but sort of the notion that maybe the Fed could ease off of full hawk a little earlier than what we think.
No, exactly, Melissa. The Fed has been so hawkish with their forward guidance. It's already moved the rate hike expectations. So right now, with only 4 months left in 22, we have 131 basis points of hikes priced in. So said another way, the Fed has to hike 131 basis points just to meet expectations. So if they hike, say, 75 or 50 and then another 25, that would actually be perceived as less than what's priced in right now.
So what do you make of the extreme, maybe extreme is too extreme of a word, but the elevated interest rate volatility that we were just talking about, the VIX being so muted, but yet interest rate volatility has been high. And I'm wondering, in past periods, have you seen this? What does this sort of portend?
Well, I think it makes a lot of sense because we have quantitative tightening. Just starting tomorrow, we'll be into September already, and the Fed is going to be doubling their caps and reducing their balance sheets. So quantitative easing was the Fed buying on the SOMA holdings and increasing, buying treasuries, buying tips, buying mortgages. Now they're going to be reducing that, and with the caps doubling, I think it's logical that interest rate vol is on the uptick right now.
Hey, Nancy, it's Jeff Mills. Just two real quick questions. So I was asking this yesterday to our research team and, pondering how many hikes, where do we end? How much does it matter at that point if we're recession bound already? Has what the Fed already done, is the writing on the wall? Are earnings already going to come down? And does that then seal the market's fate here? And then, in the same breath, where do you want to go in the market in that environment?
Well, the rates market is definitely pricing in this recession, slow growth. You can see that with the massively inverted yield curve. The level of 5-year break-evens is just barely above the 2% target. So even though the Fed might have retired that dirty word transitory, the rates market has not. So the rates market is definitely pricing in a disinflationary, slowing inflation growth. Actually, low growth, maybe even recession is priced in. But the equity markets and credit markets are still, even though we've had a little bit of a pullback right now, they're still doing pretty well. So I think the question is, which market is going to be right? Because we really have two different stories going on, whether you're looking at corporate America versus the government bond markets.
Nancy, I saw you in the halftime report in the middle of June when everybody was overwhelmingly bearish. I think the S&P was 3650 or so. You actually thought you could see a move to 4,200. That happened a lot quicker probably than people realize. I'm not looking to play stock market, but what do equities look like for you right now with this rate environment?
I think the Fed has done a lot of forward guidance, and I think if they don't, say they hike 50 in September, I think that it will be risk on, because the market is really priced for that 131 basis points through the end of the year. So there is a lot of room to not meet those expectations. So we'll see. But I'm with you, Guy. I think people are very bearish in the middle of June, and there could be a lot of room. I think so much of the consensus is for a recession, and positioning is that way.
Right. Nancy, great to see you. Thank you so much for coming by.
Thanks for having me.
Nancy Davis of Quadratic. It is amazing to think that we have become inured to massive rate hikes, and that 50 basis points would actually be bullish for the market, Steve, because it's not 75.
I know, and the problem is, you brought it up to Nancy, that if we're looking at quantitative tightening, that's the equivalent of 25 basis points right there. So even if you get 50, you get 75. You get 75, you get 100. So quick math there. So if you see that, if you see the tightening, we have no idea what the effect is going to be. So at this point, it's a wait-and-see approach. You have to be data dependent, and we'll see where the markets fall at the end of the year.
Tim?
Well, the bond market may be more overpriced than the equity market. That's the problem right now for a lot of people, again, at least in terms of real rates. And this is what we talk about all the time. I do think that the Fed is going to have to hold course. And I think the labor market, we've got a payroll number on Friday. And if the equities want a chance to rally a little bit, if we actually see some job deterioration, which the ADP numbers out today, and we've pointed, we all know that ADP and the government's numbers are not necessarily in sync. ADP's changing actually some of their calculation methods. But the bottom line is that the job market is where the Fed needs to be focused. And if this is a very strong number, it's going to push rates up even higher. I do think rates have to stay higher. I do think bond prices probably need to come down. All of this leads to credit issues that we even haven't to start to talk about. But again, I think we have ranges to trade in, and I think positioning is well prepared for a long December.